Welcome. My name is Paul Adams from EverEdge Global. I'm here to speak to you today about intangible asset valuation, the missing trillions. So without further ado, let's jump into it straight away. Let me just share my screen. Okay, so let's start with a very few brief words about who we are. EverEdge is an intangible asset specialist. We like to say we can deal with all the assets inside your business that you can't drop on your foot. We have offices in Singapore, Sydney, and Auckland, New Zealand. Been around for about 12 years. We've done over 1,000 client engagements. Net Promoter Score, if you're familiar with that metric, is plus 63%, which essentially means every client gives us a 9 or a 10 out of 10 for client satisfaction. And we've been ranked amongst the top IP strategists globally for the last now 8 years consecutively. Clients range from everybody from Fortune 100 companies right through to ambitious startups. What we do is really simple. We work with either a company or its investors to do 4 key things. Number 1, to identify what their valuable intangible assets actually are. Number 2, to figure out what the risks to those assets are and figure out strategies to protect those assets more effectively. 3, to assess and value them, and that's going to be the subject matter of this discussion today. And then finally, how to unlock value. All right, so enough about us. Let's jump into the main event, which is in talking about valuation. So this is the starting point of the, really. In 1975, you can see that intangible assets accounted for barely 17% of all corporate value. And today it's over 90%. Right? And those intangible assets everywhere. They're not just in the things that people traditionally think of, such as patents or trademarks, but in a whole host of different asset types, including things like confidential information, regulatory approvals, data is obviously a critical new asset class, software code, networks, relationships, systems, and processes. And what's really interesting is that the research shows very clearly that virtually all earnings growth in companies today is driven by these intangible assets. Now, the big irony is most companies, most capital providers, most advisors, despite everything I've just said, still tend to focus on fixed assets. And there's an awful lot of running around tracking of chairs and laptops and company cars and plant equipment. And actually a very large gap has opened up really effectively on the one hand between what a company accounts say a company is worth and the actual reality of where real value and growth and risk is occurring within the business, which is all within those intangible assets. And the reason for this is fundamentally the accounting treatment of intangible assets, because the accounting standards were designed for this kind of era, where there was all about fixed assets and equipment and plant, etc. And so if we think about how the accounting standards actually value intangible assets or treat them, they're either completely off balance sheet, so they simply don't make the balance sheet at all, or they go on at goodwill. And the issue with goodwill is that it tends to essentially be a big amorphous mass in which it's very hard to distinguish and define the assets that are within it. Or the last option is that intangible assets will go on at cost. Now, cost is actually the worst of the 3 because cost leads you to the conclusion, the erroneous conclusion, that the number on the balance sheet is actually correct. And the reality is there's basically no correlation between cost and value with intangible assets. And that's really problematic because what it means is that that number can be very, very wrong indeed, which begs the question then, how do you value intangible assets? And that's something we're going to talk to in a moment. Now, the result of this is that you have super valuable intangible assets on the one hand, and on the other hand, that they're largely ignored. You find that many C-suites and many boards of directors, etc., do not understand, number one, what intangible assets they actually own. It's quite common that we would see companies that they intuitively understand that they have valuable intangibles, but they cannot tell you what they actually are. Number 2, most companies don't understand the extent of the risks associated with those assets because they don't understand those assets in the first place. Number 3, they are unclear or unsure about how those assets actually impact on their own financial results. So I'll give you a simple example. And say I go into a market in Thailand and I buy a t-shirt for $2. I sew on a Prada label. Now that thing's suddenly worth $100. But if we think about how that's going to show in the P&L, it's going to be revenue $100, cost of goods sold $2, gross profit $98. Now we know the $98 came from the Prada brand, but in even a simple P&L, that connection between the asset and the value that's created quickly gets severed or lost. And so many companies can't actually tell you which assets are actually generating their actual real value in their margins. And it makes sense then if you don't understand what you own, you don't understand what your risks are to those assets, and you don't understand how those assets impact your financial results, and how do you unlock value? And so that's really what I want to talk to you today about. How do companies value these intangible assets? Well, the first way a lot of companies do that, particularly smaller companies and startups things, is completely arbitrary. Somebody will say something like, I need to raise $3 million. I don't want to give away more than 30% of my company, so therefore I'm worth $9 or $10 million. And the problem with that is it is just that, it's arbitrary. Anybody could come up with another figure. Investors could say, you want $3 million, I want 50% of your company, so you're worth $6 million. And both are equally wrong or right. And this is an example of just how misleading arbitrary numbers can be. So this was a case study of a client we worked with, and they were entering into a joint venture that was valued at about $50 million. Both parties were contributing $25 million in cash. It was a 50-50 JV. Now, our client was also contributing very valuable intangible assets, and we pointed out that those intangible assets should adjust the cash component of the transaction. So we did a valuation of these intangible assets and came up with a number and provided it to the counterparty. It was a very large North American company. And initially, the North American company said, look, we reject the valuation and we think that the intangibles are worth precisely what they're on the balance sheet, which is zero, right? So they effectively were not on the balance sheet. They just described an arbitrary number of zero to them. We indicated that, well, if those assets are worth zero, then we should probably not include them in the transaction or the JV because they're valueless. Now, at that point, the North American company realized that actually these assets were really valuable indeed. They were data and software and industry know-how. And so they ended up, in fact, accepting the valuation that we had prepared. And the consequence for our client, instead of needing to put in 25 million in cash, they only needed to put in 3 million in cash. In other words, we saved them 22 million. The key point here is that the valuation that had been ascribed by the counterparty was completely arbitrary, essentially. There was no justification for it whatsoever. And in fact, you could derive an effective valuation if you went through a valuation model. And we know that that was the case because the counterparty here had no interest in accepting that $22 million number unless it actually perceived there was real value. The second mechanism that you often find for the valuation of intangible assets is, as I mentioned before, is cost. And cost is very effective when we look at things like tractors and plant equipment, but cost is a terrible measure of a lot of in many cases for intangible assets. So if we think about Velcro, for example, how much did it cost the original inventor of Velcro to realize as you're strolling through the Swiss Alps, which is apparently the origins of the Velcro story, and the little bitty bit, we call them the little sticky seed attached to his socks? What was the cost of the idea that could be turned into Velcro, right? So cost is actually a very poor measure of valuation when it comes to intangible assets at all, but very good for fixed assets. So here we have another example of this. So here we have a client who developed a real game-changing technology, but developed and grew up a company, but failed ultimately to commercialize that. The management team abandons the business and investors are just left with the failed company. Now, the assets in this case had a certain level of cost associated with them that have been recorded on the balance sheet that was effectively irrelevant to the real value of the business. We were asked to get involved by the investors, and we looked at what was going on and recognized that these assets were vastly more valuable than what they were, or what the cost that had been associated with their building. And we researched potential buyers, we ran a sales process, we ultimately negotiated with multiple parties, and we sold those intangible assets for tens of millions of dollars. In fact, we returned $45 back to the investors for every $1 they invested into this business. The cost of those assets was completely irrelevant to their real value at all. A third method that people will look to in trying to value intangible assets is this one, is income. They'll say, right, we have some historical cash flows and we've got a level of future cash flows. Now, those future cash flows can look a number of different ways. They could be a continuation of what you see here, like as you see here, a continuation of a historical trend. And if your business is doing that, if it's mature and it's stable and it's got very durable cash flows that are very predictable, actually cash flows can be a very effective measure of future value. But this is not often the case. So often we'll have situations like this one, for example, where there's a significant change in trajectory of the cash flows. Or we might have this one, which is a startup where there are no historical cash flows at all. And what we're expecting to see is negative and then moving into positive cash flows over time, and which are often unpredictable. Or we'll have this one here in which we have a liquidation or receivership or a bankruptcy in which the historical cash flows have dropped away to zero and there's no cash flows predicted whatsoever, as in the previous example. So this is really problematic because income-based or cash flow-based valuation, very effective when you have these stable businesses, but not very effective in many scenarios that you'll encounter today. The question then is, how do you value those intangible assets? And here's an example of exactly this, about exactly why the historical based but future prediction of cash flows can be so misleading. Here we had a client who was developing a very disruptive data center technology. They needed over 100 million for the initial build. Now, they were just a team with an idea at this point, with just intangible assets. They had no historical cash flows really to speak of, and the future cash flows were very unpredictable. Now, based upon that, a Big Four accounting firm valued them at 40 million pre-money. And the issue here is that it really made the raise non-viable. They needed to raise well over 100 million to make this work. So the client approached us and we looked at what they were doing and recognized the importance of the intangible assets, recognized the impact that they were likely to have on that industry. And we completed a very comprehensive valuation of those intangible assets and the company with reference to its intangible assets, and valued them at over 200 million. Now, it would be fair to say that Big Four accounting firm did not accept our valuation, but our client was very happy with it and took it to a major investment bank in New York who said, "We love this." They ultimately went out and raised 400 million in equity and 750 million in debt. And then in Q4 2019, they exited for an excess of $3 billion. Now, the point here is this: that if they had relied solely on the valuation that had been provided to them by the Big Four that was based upon these very non-predictable future cash flows, it really would have meant the whole company would never have gotten going in the first place. The final method that people will sometimes use is they attempt to value intangible assets as comparatives, as this one. And as the picture suggests, the big issue here is that intangibles by their nature tend to be very unique and discrete. And it's very hard to make a true apples to apples comparison. And so you end up actually comparing the wrong things. And so here is a classic case of this one. So here we have a client of ours who was exiting their business, and the investment bank managing the transaction did the very standard sort of EBITDA style multiplier. We multiply the EBITDA of the business through some sort of industry standard multiplier. We looked at what they're doing and went, hold on, the most valuable asset in this business is its data. And that data is not on balance sheet. We have no cost for it essentially, and it's not being recognized in the sales process at all. And comparing this company against its peers will not recognize the value of its data because they don't have that very valuable data. So we prepared an intangible asset story and we really highlighted the value of the data. And we talked about data a lot, and we targeted people who wanted to buy data, not who wanted to buy an operating business. In other words, the comparables were irrelevant. The company was ultimately purchased by a strategic buyer for that data. And we ended up selling that business for 32 times EBITDA, not 4 times EBITDA. We got the owner 8 times the money that they would otherwise have received. Again, the point is here is that the comparatives, their peers, were simply not a relevant point of comparison for this business as well from a valuations perspective at all. So in other words, what we find if we look at the big picture here is the traditional way of valuing business is this, is that you have fixed assets and cash and put those into operation, and it generates a cash flow, which ultimately, hopefully spits out a positive EBITDA, and that's multiplied through some kind of industry standard multiplier to give you a valuation, right? The issue there, and the issue that we've got really, is that what it fails to recognize is that not only are intangible assets actually the drivers of cash flow today, but secondly, they are the things that actually really drive strategic value, the things that actually people will pay above and beyond the simple standard multiplier or cost basis, etc. Intangible assets are the heart of value today. And we should also recognize, though this is probably a discussion for another webinar, that they're also a kind of substantial source of risk in valuation as well, that they can be a thing that drives value down in businesses. So I want to finish on just by saying that over the last 45 years, what we've seen is a massive migration of value and risk, from intangibles being only 17% of all company value to now being over 90%. But that migration is not typically reflected in the company accounts, and therefore it's not typically reflected in the way that we value businesses either, and way we value intangible assets. Intangible assets are now the primary source of virtually all company performance and risk, and therefore also value, and it's incumbent upon us to understand how to value these assets if we are going to generate the right outcomes for our clients. And then finally, I'd argue this is a trend that is not going back. The arrow is only pointing one direction. We're not suddenly going to have an economy that is more based on bricks and mortar. It is going to be more and more about intangible assets going forward. So thank you very much for your attention. I hope you found this interesting.